Hi, good morning, good afternoon, and good evening, everyone. Welcome to attend our webinar on digital asset tax issues. I'm Darlene Chen, a corporate attorney at Hoge, Fenton, Jones, Appel. Hoge Fenton is a member of Mackrell International in North California, America. We have about 50 attorneys, 3 offices in the San Francisco Bay Area, and with our headquarters in the heart of Silicon Valley. My practice is focused on corporate governance, merger and acquisitions, and venture financing. I'm also active in handling technology transfer and cross-border transactions matters. Mackrell International is a global network of independent law firms. It is headquartered in London, with 90 members representing a total of 4,500 lawyers and attorneys working out of 170 offices in 60 countries. It effortlessly delivers global expertise and local influence. Currently, it has over 27 practice groups with Mackrell International. Each Mackrell International practice group represents a center of global excellency in its specific area. Lawyers in these groups work together on client assignments all over the world to exchange best practice and develop a shared response to emergent trends to share with the clients. The groups also regularly meet in person and online. The Cryptocurrency and Blockchain Practice Group was formed last year. It is my great pleasure to serve as its founding practice group leader. Attorneys from our practice group hail from jurisdictions like Singapore, Serbia, Italy, Hong Kong, Colombia, Ghana, US, and the UK. They navigate clients who are key players in the blockchain ecosystem through the complex and uncertain business and regulatory landscape surrounding cryptocurrencies and other crypto assets across the world. Clients will benefit from a multi-jurisdiction network of expertise from lawyers with regulatory, corporate, real estate, tax, technology, data protection, and privacy, banking, merger and acquisition, and securities law experiences, as well as being familiar with cutting-edge blockchain technology. Without further ado, I'm passing the baton to the moderator of our webinar today. Thomas, the floor is yours.
Thank you, Darlene. So I'm Tom Hulme. I am from the UK, the English Mackrell firm. I'm the head of the blockchain and cryptoasset team here, and we're joined today with John Wedge from BKL, Geraint Jones from BKL, Sam Ingersoll from BKL, Yuting Wang from Armenio, and Noah from Armenio as well. John, would you like to introduce yourself and we'll go through the panelists?
I'll mute myself first. Yes, thank you, Tom. My name is John Wedge. I'm a financial services partner here at BKL. We are a firm of chartered accountants, auditors, and tax advisors based in London. My background is in financial services, particularly working in payment services and with payment platform providers. And it's that led me down the weird and wonderful rabbit hole that is cryptocurrencies.
Thank you very much, John. My name is Geraint Jones. I'm head of private clients at BKL. I specialize in private client tax, non-dom, non-res people, high net worth individuals, and I followed John down the rabbit hole of cryptocurrency, from which I'm yet to emerge.
Sorry about that, Geraint.
I'm the final one for BKL. I'm Sam Ingersoll. I'm an ex-auditor and now a manager in the tax consultancy team. Have been introduced to the world of cryptocurrencies by John and help out on the corporate side and also look at some of the structuring that we can do to help reduce tax liabilities when individuals start to pay more tax than they would like to.
Yuting Wang. I am tax partner with Armenino LLP, based in San Jose, California. Armenino is a full-size accounting firm. Our headquarters is in San Ramon, California. We have about 1,500 employees, about 130 partners, offices across the United States with California, Seattle, Denver, Dallas, My main practice area is really tax, and my main focus client group is closely held business and high net worth individual. Specialties in helping client with tax plannings and compliance, especially with equity investment, stock option plannings, and same with Gern that the past 12 months down in the rabbit hole of cryptocurrencies, and really fortunate to work with Noah Baxter, our leader in the blockchain team, to help clients with a lot of plannings and compliance for cryptocurrencies. Noah, it's your turn.
All right, that's me. Yeah, I'm Noah Buxton with Armanino. I'm a young father who has a 6-month-old who decided 4 a.m. was the wake up time today. So, I'm pumping myself with caffeine, but super excited to be here today. I'm a managing director with Armanino, as Yu-Ting said, a West Coast-based accounting firm, and I lead our digital asset and blockchain practice. I've had the pleasure of working with crypto clients since about early 2016, and leading a practice here at Armanino since 2019. And I call myself a reformed attorney, not in a disparaging way to our audience here, but that is how I started my career. Before moving into public accounting, I was practicing law. So today I get to put my passion and my experience to work in a few different ways. I, of course, lead our blockchain practice. I act as a subject matter expert for some of our crypto clients. Riding along with Yu-Ting on some of these complex tax engagements is a great example. And also then leading a team that builds new products directly tailored for the needs of this industry. So happy to tell you more about that and happy to be here. Thanks.
Thank you all. Thank you all very much. So we thought it'd be interesting to launch a poll right now, just to, we've got various, attendees. So it'd be interesting to see who actually thinks what of digital assets. So if you feel free to answer the poll. We'll give it a couple of minutes. And then perhaps, we've got a bit of a Q&A at the end, and we can talk about the various views on the digital asset market. Okay, I think so votes coming in. Okay, I think it's probably about there. So I'll explain the results to you now. We have 23% of people that think that the answer would be between 6 and 2 years, 51% between 2 and 5 years, the vast majority, 21% 10 years, and 5% never. So it's quite interesting. It seems that the vast majority of the audience think that it's inevitable that between 2 and 5 years things are going to become a bit more involved in the market. So we'll move on in the discussion now. So we looked, we're going to first have John and Noah talk about where we are in the landscape, what sort of clients they're seeing, where the changes are. We're then going to move to, I believe, Sam and Noah to talk about tax considerations for either typical companies or crypto asset companies dealing with crypto assets. Moving on to individuals with Grant and Yu-Ting. And then following that, we'll talk about some practical circumstances where tax structures are particularly pertinent for certain situations. And then finally, we'll move on to the Q&A where we can try and answer some of your questions which you've already seen come in. So the landscape, we've seen Bitcoin was released in 2009. Since then, every 3 to 6 months there seems to be a new change in the industry. So with that, we've seen more businesses, more individuals, acquire crypto assets, realize huge gains using them, and some interesting conversations to be had. So John, we'll start with you, and this is a conversation to be had. How would you say the commercial landscape and the use of digital assets has changed over the last 12 to 18 months?
It's a good question. I think a lot's happened in the last few days, let alone maybe the last 12 to 18 months in the world of crypto. But I guess from a UK perspective, what we're seeing is, I think we seem to be in a sort of some kind of stage of early acceptance or acceptance and adoption of this kind of technology, or at least embracing of it. but I think in some ways it's not perhaps quite yet as the intended use case. So if you take BTC, that's kind of like a mode of payment or a store of value, right? It's not really necessarily being used entirely in that way right now. So kind of what I mean is, I think the volatility of these assets is bringing speculators into the market. I mean, look at what a few tweets over a week from Elon Musk can do to the price of Bitcoin. But then as well, when you're looking at a new market like this, there's inefficiencies within the market. So there's lots of exchanges. Obviously, opportunities are there to kind of arbitrage against exchanges and against prices. So kind of seeing a return to a lot of high frequency trading activity that maybe disappeared from normal financial markets some time ago. Dump on top of that, I suppose in the UK and EU, you've got the 5th money laundering directive, which has come in. So that's seeking to regulate guys that are running exchanges or providing OTC transactional services in this. More recently, we're getting involved in things around non-fungible tokens, and you've got some of the large auction houses now selling digital assets and digital artwork. And now we're going into this is probably something that's quite new, could be exciting, could be dangerous in many ways, but it's certain DeFi products where people are allowed to, you can collateralize your assets, you can finance them, you can stake them for returns, all these different types of new products coming to the market that aren't necessarily offered by a traditional financial institution like a bank.
Sounds good, thanks, John. Noah, have you got anything to add to that, maybe from your perspective on the other side of the pond?
Off mute now. Sure, happy to add to that. I think I would say first as a disclaimer for anybody in the audience who's just getting their arms around crypto or just interested in how you can provide your professional expertise to these types of clients, don't worry, it's moving so fast that even people who do it all day, every day have trouble keeping up. And that's because, as John alluded to, there's just this sort of general market change in terms of these asset prices and who's involved and who's trading and what's happening. There are new players entering the market, and both from a project perspective, new token projects coming in and trying to solve, the next big problem in the world, and trying to offer the promise of blockchain as the solution. You've got some, really interesting technology moves in terms of non-fungible tokens, and as John mentioned, DeFi too. So I would say those are big changes. I would also just go back to the polling question and maybe challenge the idea a little bit and ask people to think about, are we asking that digital assets will be used in commercial transactions or used by sort of existing financial or market players and that they will just adopt it? Or are we looking at some mix of things where actually what we're talking about is disruption? I think DeFi is a great example of how the traditional loan officer, the traditional lending office is subject to serious disruption when you can, in a trustless way, allow two parties or one party even to earn yield on their money or to borrow money without the involvement of a centralized party. That's a pretty compelling thing, and it's shown. I think is it $50 billion of total value locked or so in DeFi protocols today. So that's again a small amount in the grand scheme of financial markets, but incredibly promising move when you see that the 50 billion has been locked over effectively the last few months. So again, pace of change very high, but yeah, that's what I would say. There's many other things that we could talk about in the last 12 months, but I'll leave it at that for brevity's sake.
Yeah, thanks. I mean, you're absolutely right, though, Noah. I mean, the phrasing of the poll is almost quite broad, and I think, as we've all experienced, and as John and Noah, you both said, the landscape just changes every 3 to 6 months, and you've got to sort of realign yourself. So, what we might use now, digital asset, the way we might use digital assets now, may be completely different in 3 months' time, completely different in 6 months' time. We're talking about the hype about NFTs. That wasn't there, 12 months ago. You got ICOs a couple of years ago. So it's one of those things, isn't it? But moving on, we'll start with John again. What do you think the biggest risks and challenges are, for the crypto asset industry and maybe traditional players looking to get into that industry?
Yeah, okay. I guess there's a fair few. One of the biggest things that or the biggest problems is there's a real lack of infrastructure within sort of the digital asset market. So there's not the traditional players like your traditional prime brokerage houses or your traditional custodians or these types of entities. So, you know, if you're going to get involved in this, particularly if it's holding money for clients, there's lots to think about in terms of safe custody of assets and things like that have to be dealt with. But you've got to kind of balance with it being sort of safe and in cold wallet storage, so it's not online, but you've got to have certain elements online so that trades can happen and clients can execute trades. So there's those types of complications. I think regulation, I alluded to the Fifth Money Laundering Directive, that came in early this year in January. I suspect regulation is going to get tighter in this area more than anything. So you've really got to be careful and almost treat this, you know, like this is going to be a heavily regulated industry. I would suspect from a UK perspective. I don't know if that's going to happen in the US, but I suspect they're tightening up a bit. And I think as well, there's so many different types of digital asset now that can do different things. I think you really have to understand the characteristics of some of the different asset classes that are out there.
Yeah, I agree. Good points, John. Noah?
I would add tax, ironically enough, is one of the biggest hurdles. In the US, we've had a real dearth of guidance. The IRS is, I mean, not even behind the ball. It's normal for the regulator to be a bit behind innovation. I think we can all understand that. This has been, you know, on a different field completely. Some of it their fault, I think, and some of it not their fault. Again, we talked about the pace of change. This has been an innovation that's been incredibly hard to keep up with. So I think what we have is very limited guidance, and I think that has been a big impediment. Not only that, you have the treatment of, I believe this is the same in the UK as the US, treatment of cryptocurrency as property, and therefore gets property treatment. And for the individual, it means capital gains treatment for purchase and sale or, you know, trade activity, as well as income treatment for assets earned from activities like mining or, you know, contributing to the network and receiving a reward from that network is income. And so, you know, if we talk about adoption, people have always thought, you know, well, when I can pay for a cup of coffee with Bitcoin, right? People would say that's when we'll see retail adoption, when we can really see the functions of money being realized, right? A unit of account, a store of value, and a medium of exchange. Things aren't money unless they can serve those three functions. And so Bitcoin arguably has a pretty good store of value, although volatile, you could say. It's certainly borderless and frictionless, and I can pay anybody I want large sums of money for very low fees. So I think it does a great job there. But is it a unit of account? No. And one of the reasons for that is tax. I'm not going to pay capital gains on a cup of coffee. And so I think that's a big hindrance. In the US, we also have, if you think of not at the individual level, but more at the public investment level or publicly traded level, the Securities and Exchange Commission has been a little bit more forward than the IRS, but also not incredibly helpful. And that means that, you know, investment funds, other sort of otherwise regulated activities have been hindered. You could go either way on that. Actually, I think that in some regards that's good. The markets probably were not ready for a crypto ETF, so to speak, not mature enough. And so I think that actually has been a good thing. However, they have not been as clear around securities treatment for token projects, and I think that continues to be a big problem. There have been some private rulings, but those don't create, you know, precedent for other projects to follow, and therefore you've got, again, continued ambiguity. The regulatory changes are big. I think the FATF, the recent FATF, or the Financial Action Task Force that deals with global money transmitter regulations and anti-money laundering, know your customer requirements, is proposing some interesting rules. I think they call it the unhosted wallet rule, not a terminology that anybody in crypto in a professional or retail sense uses. Again, the regulator sort of being off the mark there, but the idea is that if an individual transfers crypto from an exchange to an outside wallet, again, a withdrawal, if I want to take crypto from Binance.com and put it on my own hardware wallet, that would be a hop that is tracked and reported, and that also the second hop would be tracked and reported. That I think is a big hindrance because it doesn't treat, it's from a financial privacy perspective, it's completely disparate to what traditional finance and the way that those types of cash hops are treated. And so when you have disparate treatment, you have you know, pretty bad market outcomes, and people won't invest, people won't you know, trust these assets. So I think there's some other things on my list, but again, I go too long. So
I agree with you there, Nara. This is the balance between regulation, making it safe and allowing an industry to grow, or kind of killing it and not allowing it to flourish, isn't it?
indeed.
Yeah, I mean, very interesting points. I mean, it's to me, it sounds like regulation and definition is the way forward. But we'll wait and see. I mean, well, thanks, John and Noah. We could talk for ages about, where the crypto industry is, where it's going. But let's move on to the corporate matter, shall we? So we've got Noah. Unfortunately you can't go away yet. You're going to help us some more with the corporate matters, and Sam. Let's talk about some corporate tax matters. So Sam, let's start with you. You haven't had a chance to speak much yet. What would you say is the most common use for digital assets in business? And I mean typical business. I don't mean crypto asset exchange and crypto asset wallet providers. I mean the businesses are dipping their toe in the water, so to speak.
So I think there's a few different areas here. There's passive income generation. So if they already hold some assets for investment purposes, then you can stake them, or you can do mining to generate more income. So there's kind of a passive source of income, which we're seeing a lot of. There's obviously the investment part as well, where people are trying to take advantage of some of these massive gains that are happening in a minute. Probably caution it with, there are also people making equal losses in some instances on the other side. So we are seeing both. There's market makers, traders who are looking to spin and act in the middle and broke. But there's also the companies receiving payments in cryptocurrency, which is interesting really, because you've got the two sides to that. They're either getting paid and holding, and then treating it as an investment to try and get some of the upside. But they're also, I think BKL is a company that we will receive payments in cryptocurrency but spin it into fiat currency straight away. So we're happy to accept and welcome payments in that, but we don't necessarily want to take the risk of holding cryptocurrency going forward. So I think those kind of what we're seeing. From a UK perspective, I'm not seeing a huge amount of people coming with DeFi questions or coming up with new cryptos or tokens, but I think that's because in the UK there's a lot more regulation around that, which is kind of prohibiting a lot of it happening in the UK. So yeah, I suppose that's a high level view of what we're seeing corporates getting involved in, really.
Thanks, Sam. Noah, have you got anything to add?
No, I think that was, well, yes. I'll add a couple of things. That was a fair statement of the landscape for sure. I think we are seeing a few more corporates that are token projects, and I think there's been some interesting structuring that's taken place in terms of using offshore or favorable jurisdictions to create foundations that essentially can launch these token projects and be somewhat involved in their governance, and then putting an onshore entity or local sort of jurisdiction entity that is more of a service relationship to the foundation. I'm not the tax expert on the call, but I do get to work on some of these and learn a lot from them. Some of the issues that I think come up even in that structuring with the onshore entity, if you imagine that this is a token project, again, they're going to solve a climate issue or solve enterprise tracking or something on public networks. They issue a bunch of these tokens. Some of those are purchased by a corporate entity onshore, but then that entity wants to do some employee compensation, for instance, or management of that treasury of tokens. It's creating just an absolute thicket of tax issues with the employee comp, for sure. There's also sort of future employee comp or future vesting that some of these projects are doing, and it creates not only the sort of tax treatment issues, but also generally speaking, these data tracking issues. I feel like a lot of the crypto tax problems right now, both corporate and individual, are really just data problems. You could say, okay, let's treat it like a marketable security, and then we can understand the treatment. But then it's like, okay, how do we get our arms around all of this activity and basis tracking and all the ins and outs? So that's what I would add.
That's fair points. I mean, Sam, so say you're a business and you're thinking of considering, either accepting payment in Bitcoin or you're thinking of taking a view on the price of Bitcoin or any of the various things that you and Noah have spoken about, what situations should a business be aware of and sort of think, well, actually, I need to speak to my accountant because this might be a tax consideration here from a UK perspective, of course?
It's an interesting one. I think there's where you're receiving cryptocurrency for an exchange of services, you're obviously going to be taxed on it for the value of the service you're providing. So that'll be income. But as soon as you shift it to and hold the cryptocurrency instead of realizing it's cash, you're getting into one of two regimes. Either way, for accounting, it will sit in intangible fixed assets. But if you're holding for a long-term gain, you're falling into capital gains regime. If you're holding and you're staking it or you're using it in your trade still, you're going to be falling into the intangible fixed asset regime. So and each of those have different rules. If you're making money, the end result is that you're going to be taxed at 19% on any gains or any kind of uplift in value, but the losses treatment are different, and that's something which needs to be considered. I suppose for a kind of a more corporate point of view, you've got to be quite careful if you have a potential for considerable downside, which will take you into a negative retained earnings position. You're going to create a dividend block. So that's something you need to really think about, plan, and work out, is it something you want to do in your entity, or do you need to start structuring a group in place to really think about how you protect the assets of your trading business? But yeah, it's things to think about, and the loss rules are where it gets complicated. And you've got to remember that where you're making capital losses, those are ring fenced for capital gains, and there aren't many trading businesses making capital gains. It's more of you're getting income, so you've got to be really careful on that point. It's probably my biggest not word of warning, but something you need to think about.
Great, thanks, Sam. How about you, Tim? Can you tell us about maybe the US perspective? Is there anything to add, you think, that beyond what Sam's already said?
No, if anything, just maybe summarize in a way that in the US, it really depends on how you hold the property. Are you holding the property as investment property, or are you holding the property as inventory, or what you're doing with the property? From a corporate aspect, like Noah said, here what we're seeing is a lot of high-tech companies are using token to incentivize their employees. And so that creates a lot of employment issues, or taxations around that area. So the structure of setting up the foundations might have something to do with that. And also, if a company is receiving payments via virtual currencies, then like Sam alluded, you wanted to make sure that, you don't want to, if the company is holding the virtual currency received as investment properties, then other than recognizing owner income for your normal services sold or your property sold, you might want to be careful about, hey, I'm holding Bitcoins in a long-term position. What does that do with my balance sheets, my taxations? And that is also, so for from US point of view, I think IRS is trying to decide, are we really looking at cryptocurrency or virtual currency as property? Does this definition good for all, or sometimes virtual currency is really a real currency? And one of the days, if virtual currency becomes a real currency, what do we do about the taxation? Do you really tax them as foreign exchange gain or loss, like you convert USD to Australian dollars or euros, or you still consider them as investment property?
Thank you, Tim. I think, as a lawyer here, it really comes down to that typical answer, which is it depends, doesn't it? It depends what they're being used for, what they're being gained for, what you're intending them for. Client's favourite answer.
I think we lost Thomas.
I feel like I might have done.
Oh, hello?
We're back.
So you come back.
Oh, I'm back. Good. Sorry, sorry about that. Sorry. So we've covered all the quite a few corporate matters. Let's move on to the private client matters now. Darlene, you had a chance to speak. We'll start with you. What are you what's the main reason? What are you seeing, the most common activity for individuals holding, buying, and using, digital assets?
Well, my clients seem to fall down into three main categories. I mean, there's the out and out gamblers, and there's quite a few of those because the industry, at least in the UK, has been very attractive towards poker players. In the UK, gambling is tax-free. So a lot of poker players used to spend their spare time playing on the crypto markets in the hope that it would be regarded as gambling and therefore tax-free. Unfortunately, they were in for quite a shock. But those people were trading on a very large scale. They weren't just buying and selling, they were arbitraging between exchanges. They were playing the futures market, maybe the options market. They're very bright individuals, they're very mathematical, all of them, and they all were very involved in the industry. The second category of people I saw a lot of were the kind of home amateurs, for want of a better phrase, the people who saw a rising market and thought it might be quite fun to do a bit of speculation, and ended up doing far better than their wildest dreams, and then all lost it a few months later. Probably the third category of people are the professionals, as I call them, the ones who are heavily involved in blockchain and crypto, and they might be writing the next generation of blockchain software. They're the ones who are very heavily involved. They're often being remunerated with tokens and with coins, some of which you've never heard of before and have no real value at the moment, but it's all still taxable as remuneration and liable to either PAYE or income tax, depending on whether they're readily convertible assets. So there's quite a variety of people involved, and it makes for a very rich and rewarding interaction with a very wide range of different kinds of people.
Thanks, Grant. Yu-Ting, anything to add?
No, from the U.S. point of view, most of my clients I've seen is really investor position. I have a couple clients, really computer nerds, engineers. They develop their own strategies doing the tradings, and so they ended up with millions of dollars of trading. But then when it comes to tax time, it's creating problems for tax reporting, because in the U.S. a lot more people are involved in decentralized financing than what I imagined. So basis tracking becomes a big problem.
Understood. And what would you say are the biggest challenges then? I guess we've already covered some of the difficulties, but do you think there's anything that the individuals can do to overcome the challenges that have been spoken about, or any other challenges perhaps that are present to them? Yu-Ting, happy for you to answer that maybe.
So from my perspective, what I started to advise my clients is really, instead of just keeping track of the tradings on the Excel spreadsheet or relying on the blockchain to store, or your wallet to store your data, you really wanted to reach out to see if there's any commercial softwares exist on the platform that can help you to keep track of the basis, because every virtual currency swap is a taxable transaction, at least so far based on IRS definition. And every staking, every mining, every little things you do on the blockchain or on the protocol impacts your holding and impacts the basis of the virtual currency you received. So a lot of time, this past 5 months, I got into a lot of clients coming to me, handing me over the CSV data for the transactions. They do not know what to do with it. And so we need to spend time helping them to go through the transactions, to really ask them, hey, what is this transfer means? What is this deposit mean? So I think the bottom line from me is really, we need to develop a better strategy to help clients, or the client himself need to develop a better strategy to keep track of their bases and know what they're doing.
Really interesting point there. I mean, it sounds like the biggest difficulty they have is when they come to you and they're trying to deal with matters, and you're just handed a massive
Right.
spreadsheet of data, and now you're trying to work out what came in where, what traded what for what price, is it an income, are you holding it long term, Darlene, what do you think? Are you finding similar things?
Oh yeah, definitely. I'd fully agree with everything you, Ting, said there. We're seeing people coming to us with very large numbers of transactions, and if I sent that raw data to some of my staff, I'd have a walkout immediately. So we're encouraging these clients to use commercial software, and there's software out there that will take downloads direct from exchanges with read-only APIs, and also directly from wallets, and then they will kind of put them into tax speak, and then we can go through and proof them and say, well, that line there is obviously wrong. Let's try and work out what happened there, as opposed to being faced with 10,000 transactions and a member of staff gradually having a nervous breakdown.
Yeah, I mean, yeah, I can see that. So it really does sound like, it's in the best interest of those individuals. And when we're talking about these huge volumes of money and Bitcoin and transactions, it really is an investment into making sure they're dealing with the tax properly. So, what I guess, there's quite a few things that individuals should be thinking about and keeping on top of their mind. I mean, Jane, what main activities would you suggest to an individual that upon carrying them out, they should be seeking tax advice?
Well, we're in a position now where increasingly almost anything that can be done in what you could loosely call the real world can be done in the crypto world. So we're seeing more and more of a mirroring of that happening, with arbitraging and futures and options and yield farming and all kinds of weird and wonderful activities taking place. So, I'd recommend any client should really take advice up front as to exactly what they're doing, what the likely tax implications of it are going to be, what's going to be the implications of staking, what's going to be the implications of yield farming, what's it going to be of mining, and then to actually put a system in place to ensure that they have correct and accurate records, because ultimately it is up to them to have those records. HMRC are so far dealing with things on a relatively light touch basis. However, we are beginning to see inquiries coming through on our clients, admittedly letters that have been cut and pasted and are absolutely identical with the same spelling mistakes on them. But they are asking for details, and we have been asked to provide CSV files that HMRC will put through their own software to see if they kick out the same answer that we came up with. So I think, unfortunately, the days of light touch are probably coming to an end, and you need to ensure you've got excellent records and they've been kept well, and you can justify exactly the figures that we're going to put up to HMRC.
I would just add on the software front, for context here, there are a number of retail solutions, and they look great, as you said, plug in your APIs, get your information, plug in your wallet addresses. If you're doing anything more, still today, if you're doing anything more than sort of basic retail, low volume, buying on Coinbase, for instance, the output of the software is probably not correct. Having tested a bunch of them, there's really a need. First off, there's some exchanges that simply aren't supported, so then you have to upload a CSV file to the software. There's that kind of problem. Then there's also just the simple algorithm problems that come up, like is it properly treating deposits and withdrawals as they should be non-taxable. And if you do anything more complex outside of a typical exchange, the software doesn't solve it. It's not a one-click solution. So frankly, a lot of what we have, as Darlene said, is a threatened walkout. Yeah, but it's a mix of using software out into a spreadsheet, understanding, reclassifying back into the software, and that can happen a couple of times. Just also real quick, some of the other things in DeFi, I'm not sure how savvy the audience is on this, but when we talk about DeFi, again, we're talking about really two sort of use cases. Decentralized exchange, so basically replacing this centralized exchange order book run by a company where individuals come and they are either side of the order book, with a smart contract that runs that same function. And there are a couple interesting things there. In order to make those protocols actually work, you have to have liquidity of the assets, right? In the centralized exchange, you have makers and takers coming to the table, right? And they're providing this liquidity in the system. And maybe you've got some professional market makers in there too, right? To allow for volume. In the DeFi world, these are pools of liquidity provided by individuals, but not to make or take, but actually just to provide liquidity for others to be makers and takers. And this is a really interesting tax problem too, right? If I upload a pair of tokens to create liquidity, it's usually a token pair that's uploaded. Let's say I upload Ethereum and a dollar stablecoin, and that will allow other users to trade in that market pair. Is that a taxable event for my Ethereum? If I'm getting an IOU token back that says I own a certain percentage of that liquidity pool, is that a disposition of my Ethereum and my dollar stablecoin? Obviously, the dollar stablecoin is not an issue, but the Ethereum might well be. And so that's one of the interesting tax gray areas that we're coming up against. And there's token wrapping, which is a similar sort of concept. But anyway, these are, I think, completely wide open tax questions where you can make really good arguments on either side of the coin or the token, let's say.
It sounds like there's quite a lot of opportunity and quite a lot of significant issues that people can come across when dealing with crypto assets. And my take on this is, you know what, before you start anything, get some tax advice, some proper tax advice. Make sure you understand what you're doing and your potential tax liability, and make sure from the outset you've got a proper record, a clean record, perhaps helped with your accountant of how you are dealing with matters. But yeah, it sounds like we've got quite a lot to go actually. So we've covered this corporate side, the private client side. Now, I think it'd be quite interesting to talk about some real life situations where it may not be advice, it might just be straightforward accounting advice or tax advice, but actually maybe perhaps a project where a client is looking to create some form of tax structure in order to make the operations work quite efficiently. So I think this one should open the floor. Whoever would like to speak first about this, please go ahead. Perhaps Sam, pick on you.
I'm happy to jump in. It's an interesting one. What the ones I've seen recently are where you have individuals who have a large holding, and they're looking at liquidating some of that holding and how best to structure their investment. And what you've got to realise is after they have, if we assume they've had capital gains treatment for their holdings, so they've been taxed at 20%, that's a lot of cash. And these are generally individuals who've got a fair amount of income anyway, so they're already in a fairly high tax band. So we want to think about how do you structure the onward investment. So looking at things like family investment companies or personal investment companies for that sort of thing. So that's been quite interesting. And the other side is if they want to keep hold of the crypto and possibly getting it moved into a company, so the income is, you get corporation tax on the income rather than paying income tax rates on it. So there's things you can think about, but it seems to be each person I talk to, you come up with a slightly different solution because everybody's situation is different. And we can talk in generalities like this, but the reality is that if you're coming up to retirement, you want to start thinking about inheritance tax planning, and if you've got massive gains, you need to start thinking about that sort of thing. Whereas if you're very young, you've got a lot of life still to live, and it may be that you want to stop working and you can do more personal stuff on the investment side. But I think the key points are if you can make capital gains in your own name, that's probably better than it being in a company, because if it's in a company, you get corporation tax and dividend tax as you take it out again, so you're getting hit twice. Whereas if you're doing it personally, you're only getting hit once. So lots to think about, and it's worth a conversation. A lot of the time speaking to people, it's not necessarily we're getting involved now, it's getting involved in 12 months, 24 months time, once they've made some more gains or once they're starting to want to liquidate their positions.
I can chime in
Brilliant,
here from the US side. Yeah, it's similar for what Sam was talking about. People need to be aware of if you are sitting on a large sum of unrealized capital gain for cryptocurrency holdings, you wanted to talk to an advisor for how, before you liquidate and come up with a plan for liquidation. And in the US, we are currently also under, I mean, there's Biden proposal out there that the state limitation of the wealth transfer might change. So a lot of high net worth individuals are really taking this opportunity to look at their own estate planning. And same with this cryptocurrency holders. If you're sitting on a large lump sum of cryptocurrencies, you wanted to think about, one, can I set up any kind of trust vehicles to at the same time do some wealth transfer, take the best advantage of still high lifetime exemption amount for now, or if you have other use of the cryptocurrencies, like what Sam alluded, sometimes my cryptocurrency clients does not want to really convert all the cryptocurrency into US dollars. They wanted to convert between the cryptocurrencies. Is there any other better opportunities or structures for you to do that? Not sure about setting up a corporation like you, Sam, alluded that holding cryptocurrency as investments might still be better in individual names rather than entities. The other thing I would add is sometimes I also see people trying to, especially engineers, trying to come up with some strategies or create joint ventures together to create exchange platforms or whatever they think that there might be for, or create a liquidity pool for people to participate. And a lot of engineers around Silicon Valley area, they have a lot of energies or specialties in this area. I had people come to me saying, hey, me and my friend created this protocol. We wanted to see what the best structure we should put in place. We talk to them and we send them back to say, well, tell me what you wanted to do. I mean, it's 50-50 ownership or whatever. A week or two they can back. This structure is already up and it's on the internet, and it's already attracted 26 million of traffic volumes. People are starting to use their exchange protocols to do swapping and cryptocurrency. So that creates a lot of issues, concerns, I mean, from both legal perspective and the tax perspective. So I do encourage my clients that if you wanted to do something, really talk to legal and tax advisors first before you really started to put things together, because you might be tripped into something that you don't know.
Yeah, absolutely. I mean, all planning needs to be bespoke, and you always need to think about your exit at the time that you're setting things up. Now, if you're internationally mobile, the opportunity to move around the world to more tax benign jurisdictions and spend a few years there is obviously a very attractive exit point. And even though in the UK there are anti-avoidance rules in place to stop people becoming what is called temporarily non-resident, that only involves being out of the UK for very approximately 5 years or more. So they can be fitted in with within your lifestyle if it's that kind of thing attracts you. It's an interesting area. I'm a big believer in not letting the tax tail wag the dog. That you should try to lead the life that you want to lead, and then make that as tax efficient as possible, as opposed to finding a really tax efficient life that makes you utterly miserable. So it all depends on planning and the individuals concerned. And as we keep mentioning, speak to someone at the beginning and not after you've done everything, because you can't rewrite the past.
Some really interesting points raised here. Would anyone else like to contribute for this part? If not, I'm conscious of time. We've got quite a few questions that I think we should probably answer, but I think we've probably got time for a comment from Noah or John if you feel like it's appropriate to say something.
Quick bullet points that I know are usually on Ting's list too are qualified small business stock in the U.S., which can be a great way to protect gains from the sale of company stock, which might be involved in a crypto business. Potentially taking gains, getting some accelerated depreciation on an investment in a new venture is something we've seen, as well as donor advised funds. I'm not sure what the equivalent is in the UK, but I would put those things on the checklist of things to talk to your client about or to consider.
Yeah, I think I was just going to say, I think you mentioned token generation events earlier, Noah, and I think again the structuring here does have to be really careful. I think we've seen a couple of things that come across that made us more than nervous, I think, where, yes, there's been offshore companies set up, but all the individuals that own and are directors of that business are onshore in the UK. So that's basically a UK company for tax purposes. So you've got to get the structure right. If you're going to do one of these token generation events offshore, it's going to need some kind of proper trust structure and make sure that that is offshore.
Brilliant. Okay, well, thank you all. We've got some questions in from the audience, the attendees that they submitted prior to the event and during. I'm quite grateful actually, because we've got, usually in these types of webinars, the attendee list tends to drop off, but for some reason in the tax webinar about tax, we have rather a lot of people with us, which is fantastic. So I think there's been quite a few questions about NFTs. Now, as we've already discussed, the answer is it depends. But maybe someone can tell us about NFTs, what they are, maybe the different considerations that you should be thinking about, what you should be thinking about when not just buying one, but perhaps when you're creating them. I mean, I know from my perspective, there's quite a lot of in the UK, quite a lot of issues concerning licensing and things of that nature. And if you're creating an NFT inside a business, you're going to have business costs of generating this product. So maybe someone would like to tell us about maybe some things that people should be thinking about when buying or dealing with NFTs.
I could set the stage real quick. I would say I use the same analogy when I talk about tokenization of private securities. I say, this is the same underlying vehicle or legal structure. We've just put a digital wrapper around it. So it's a digital candy wrapper, right? And the same is true, I think, mostly in NFTs. If you basically think that you can imagine you can tokenize anything, right? Anything can be tokenized. You can create a digital representation of just about anything you want. If we're talking about ownership or property rights in some, underlying, maybe it's a picture or a GIF or a video, some digital artwork, and you're essentially talking about owning it, really what you're doing is just putting a digital wrapper around a set of ownership rights that, might be analogous to sort of the traditional, I went down to the art gallery and I picked the art off the wall, and I received the certificate of authenticity from the gallery, and I paid my money, and I've got got my paperwork, and now I own this artwork and I can hang it in my house, dominion and control over my own thing. Same is true, it's just I think digitally the problem is, and also here to set the stage, I think that being said, that a lot of this still has to be worked out, especially when it comes to the token actually being connected to the digital asset or digital artwork. Is yet to be figured out. And some of these projects are now trying to connect the two, where not only is the NFT registrable on a given blockchain, but it's also stored in a given platform in perpetuity. Right now, that's not the case, I don't think.
Yeah, I think it's just as well remembering these things, they're individual, they're unique, they're not interchangeable like Bitcoin. One Bitcoin is exactly the same as another Bitcoin. I mean, these are unique tokens. And like Noah said, they prove ownership. You can buy and sell them. You can sell them to people. People will buy them off you. I think an interesting thing, we're seeing more and more of this. I mean, I mentioned there were some large auction houses selling digital artwork as NFTs. Another area we're seeing it now is in gaming, and I think this might be one of the biggest markets for it. Really, that's ultimately going to be the biggest market. Is you've got people coming in where they say they'll go to Nike or Gucci and say, hey Nike, that's a really cool pair of trainers. We can make a digital representation of that and sell it to people on Fortnite that they can stick on their avatar. And I mean, that's a whole different ball game. But then I guess you're talking to a whole probably generation of people there who are way more comfortable with this type of concept than maybe we are, having been used to sort of real money and debit cards.
I mean, certainly from a tax perspective and a UK perspective, HMRC have openly declared that they don't need to introduce any crypto-orientated legislation because the existing legislation is all sufficient, we all thought that was absolutely wonderful to start with, because it meant we didn't have to learn a big pile of new law. But as the market developed, we realized that this brought its own complexities, because we had to really work out exactly what was happening in any transaction, what the essence of it was, what did it really smell like at the end of the day, and then apply what we thought was the most applicable law. And as HMRC have now brought out a manual, it's still a very small and very superficial manual and doesn't go into any detail on vast tracts of stuff. So in terms of things like NFTs, you've really got to look at what really is happening here and what would be the applicable tax law in the UK to it. And then you have to apply that, and there's not going to be any pre-transaction rulings available from HMRC on it. You're just going to have to put it down on your tax returns and explanation, and then, you know, steel yourself for an argument should HMRC.
I'll just throw VAT on top of that as well, Geraint.
Yeah, of course.
VAT implications with these sorts of tokens as well. But...
yeah, absolutely. Absolutely.
Well, some interesting things to think about, and not particularly straightforward by the sounds of it, which things never are. Now, I've looked at the other questions, and actually, I think that you've managed to answer them throughout the duration of the seminar. So I think actually that brings things nicely to a close. And at this point, you know, I want to thank our panelists, and I'm going to hand back to Darlene to finish this webinar.
Okay, thank you, Thomas. Thank you, all the panelists, and especially thank you all you attending, our webinar today. And we also thank you for Mackrell International for giving us this platform and for hosting this event. And so just a reminder, the above presentations for information purpose only. It's not constitute as professional advice. So, if you want to contact one of our panelists, their contact information is on the end of the slide. So, well, we hope to see you next time, and thank you for joining. Bye.